Well, good afternoon, and thank you so much for joining us today. This is our live investments webinar. I'm Kellie DeMarco, and today we're going to be discussing Bitcoin, the market, inflation, and what's ahead for 2021. This is brought to you by Goldenstone Wealth Management. We are so happy that you're with us for the next hour. You're really going to learn some valuable information about what's happening in the marketplace. We're going to discuss things like Bitcoin, which I know you're excited about, as am I, and really find out the best ways to invest your money in this dynamic world that we live in today. A little bit about me again. My name's Kellie DeMarco. I'm a former television news anchor and now a media relations specialist here in Sacramento, California. And I'm a good friend of Sanjay's, and I've really loved being a part of these webinars because I really learned a lot of information about how to invest my own money. And I used to love covering business and finance. So this is really fun for me. And I've just loved getting to know our past panelists. If you're joining us for one or two or three webinars, thank you so much, by the way. Great to have you on here today. So let's introduce our panelists today. First off, live from New York, it's Kyle Chapman. He is the vice president at BlackRock. Let's see you, Kyle, pop up. There you are. He is the vice president at BlackRock. And Kyle focuses on building exchange-traded funds as they relate to megatrends, topics like technological breakthroughs, demographics, and social change and emerging global wealth. Kyle has also worked as an equity capital market specialist at Citigroup before entering into the venture capital space as a technology investor. So thanks for joining us, Kyle.
Yeah, thank you for having me. Pleasure to be here.
Okay, we've got two other panelists that we want to introduce now, live from Sacramento, the founder and principal at Goldenstone Wealth Management, Sanjay Varshney. As he comes up here, hey, Sanjay, nice to see you.
Good afternoon.
Sanjay was a senior wealth management executive for several years at Wells Fargo's private bank. He led the investment group for over $200 billion in assets. He's also served as dean of the business school at Sacramento State, and Dr. Varshney still serves as professor of finance. By the way, he produces a little show and a big book, of Sacramento Business Review, that we'll talk about later on in the show, but really nice to have you on here, Sanjay. And also today, finally, certainly last but not least, is our friend Andres Villegas. This is Sanjay's business partner and co-founder at principal at Goldenstone Wealth Management. Andres, always nice to see you. Thanks for joining us today.
Hi, Kellie. Always good to see you as well.
Andres, by the way, was a vice president and senior investment strategist for nearly a decade at Wells Fargo Private Bank. I believe that's where you two hooked up. And he managed over $450 million in assets for private clients in the Sacramento region. Andres also worked with private clients in Texas and New Mexico, as well as a lot of international clients from Latin America. So great panel, very experienced, and we're going to get going. Before we do that, though, just want to let you know, if you haven't figured it out already, you are on mute so that we can have a conversation here, but please join us in the chat box. I'd love to see you pop in there with your questions. We're going to get to those questions at the very end. So most importantly, I should say, we're just glad that you're here. This webinar is all about you and your investments. So hopefully you learn a lot of useful information as we talk about cryptocurrency today. All right, so let's jump in with a quick poll in the chat box. Let me know if you've been reading about any of these items: inflation, the housing boom, rising labor costs, yes, Bitcoin, blockchain, cryptos, Satoshi Nakamoto. I don't know if I said that right, but that's a name that keeps coming up, right? It's all in this crypto space. And I think we all have a lot of questions about where this is going. The first half of this year kicked off with a lot of uncertainties, right? Among them, inflation. You may be concerned about what inflation is not only doing to your investments, but your savings, your future expenses. And then with this whole Bitcoin thing, what is it anyway? And how can you as an investor actually use it? We're going to be tackling the boom in the housing market, but also just the fact that prices have really skyrocketed overall. I know you've probably felt it too. I have. Cars, insurance has gone up. A lot of folks in our region have felt that. Business owners are trying to incentivize their workers with higher wages and hiring bonuses. The list goes on and on. So is this a consequence of the pandemic. Sanjay, let's start with you. Talk about those items. I know you just put out your mid-year update recently, so kind of walk us through where we're at right now.
Sure. Good afternoon, everyone. So if you're asking the question, is the economy back? The answer is yes. With all the headlines about the pullout from Afghanistan and the Delta variant still basically crowding out the news, we do have some positive stuff going on in 2021 so far. And I joke about it a little bit because, in a way, we think we are back, but our lives don't really quite feel the same as it used to be before the pandemic started, right? So after 9/11, for example, travel was never the same again. Even today, I have to take off my shoes, as going through the x-rays. So the economy is back. Our economy has grown very well out of the recession, shortest recession on record ever that we have seen, the deepest recession. I think we're going to close out the year probably closer to 6% annual GDP growth rate and not 7.5 or 8 or even 10, for example, that we were predicting early on in the year. The economy is not as explosive as we thought it's going to be in the second half of the year. The Delta variant clearly has been a damper, on many parts of the economy. And the economy has not been equally good for everybody. So if you look at, for example, the technology companies like Microsoft or NVIDIA, their earnings look great. But if you're talking to the airlines folks or the hotels, restaurants, they're all still struggling because, like I said, the Delta variant is not allowing our lives to come back to normal the way it used to be. But in general, economy has come back. It's back to pre-pandemic levels. If you ask, if are we back to the pre-pandemic growth level that we used to be at in terms of overall size? The S&P 500 companies have done tremendously in this last 1 year. 46% growth rate year over year in the last year, and then 25% higher than the pre-pandemic level corporate profits. So if you're asking, are we back to pre-pandemic? We're not just back, we're actually 25% higher than that today, right? Markets, if you're an investor in this market, especially in the stock market, how can you not love it? Across the board, the market indices are up anywhere between 15 and 20%. So clearly, again, we understand there are winners and losers. Not all stocks are equal. If you look at the FANG stocks, the typical Facebook, Alphabet, Netflix, right? Apple, Google, they are now 25% of the S&P 500 index. They used to be a much smaller fraction before, right? So clearly, again, the market is not equal across the board, but the market is doing extremely well. The retail investor has risen, right? So if you're reading the news about Robinhood, which is the reason why we are doing this webinar today on cryptos, right? There's a lot of other stuff going on in the background. The Robinhood kind of traders have now basically increased from what used to be 15% of all trading to almost 25% of all trading, right? The consumer is extremely strong. You can see, for example, the consumer household incomes have gone up, their spending levels have gone up. The consumer is strong because in many cases they were not displaced if you're working for like a Microsoft. And in the cases where you were displaced, you're getting stimulus checks. And a lot of these young people, who are sitting at home with stimulus checks, they don't know what to do with that money. So they're playing with that money with Robinhood, right? Total wealth in the United States is up. $130 trillion is the total size. 12 trillion was made last year alone. And yes, the rich are getting richer because the rich know how to play this market. So in many cases, the clients obviously have been the beneficiary of that wealth creation in this country. Record levels of debt write-off. So you can see many of these consumers have actually paid off their debt with all the extra money they had in the pockets. Clearly, you couldn't go to the restaurants. You couldn't go and basically spend that money on travel, right? Labor market is back in a big way. 5.2% unemployment, which is one of the best rates we have seen in a long time. But again, it's a hit or a miss. 10 million plus jobs available, only 7 million people still unemployed and looking for a job. So in theory, anybody who's looking for a job should be able to find one. But strangely enough, many of these workers will never come back. If you've been reading the newspapers, more than half of the women have fallen out of the labor force. And then strangely enough, today, many of the men are not applying to college or dropping out from college. In fact, 60% of all applicants this last 1 year for all colleges and universities happen to be women. So you can see that the men are getting disillusioned too about the labor market, right? But in general, if you're asking the question, Are we back? The stadiums are packed. Schools are open. My kids are back to school and to college. NFL kicks off in a big way. College football stadiums are jam-packed. So I'm excited.
Yeah, I'm excited too, not just for football, but all the reasons that you've been talking about. When I look at my 401k, when I look at my investments, I'm always smiling. So that's good. We know it's not going to last forever, right? But let's get into this Bitcoin thing, because even just at home, we joke because we're on Robinhood, and I think that it really has kind of blown the door open for especially the younger generation to jump on. So Andres, let's just talk a little bit about, well, let's start with Bitcoin and blockchain and all these new crypto terms out there. And let's really dive deeper into kind of where that is headed, because at first people were nervous to jump on, but we've seen huge returns with Bitcoin. So when did it start? How many are there? Just fill us in here.
Sure, you're absolutely right, Kelly, and happy to jump in here and set the context and lay the groundwork of Bitcoin, provide a little bit of context, right? So Bitcoin is a decentralized peer-to-peer digital electronic cash payment system. So there is no central bank associated to it. There is no third-party administrator behind that controls Bitcoin. There's no company, no CEO behind it. There is no leader that has an influence about how Bitcoin was created. So that's what the decentralization means. A lot of the power of Bitcoin comes from its users. So users are effectively a whole bunch of different market players. So there's miners that work to validate transactions behind the ledger. They're incentivized to do this because they get rewarded some Bitcoin. And that secures a network. And then there's all of the other people, right? The buyers, sellers, the speculators, investors, hedge funds around it. There's a lot of different market players associated to Bitcoin. But before we get too deep into all of these different things and go down the Bitcoin rabbit hole, I think I like to focus on a couple of items. One of them is the supply of Bitcoin, so how many Bitcoin there are, and then the core technology behind it, because I think that is important. So Bitcoin was started about 12 years ago, and it was created to be designed so that only 21 million Bitcoin will ever exist. No more. And since there's no central bank associated to it that can change this and issue more Bitcoin, that provides a value against inflation, right? It has a cap in the supply, and it cannot be inflated away. Now, out of this 21 million Bitcoin, there is currently about 18, call it 19, it's less than 19 million, but call it 18 million, 19 million in circulating supply. So that's how much Bitcoin has been created since those 12 years ago. Last I checked, Bitcoin was trading around $47,000. That, doing a quick math, puts the market cap of this asset around 800 billion. Now, 800 billion is a lot of money. In fact, Bitcoin reached the 1 trillion earlier in the year. And that is the fastest that a technology has ever reached this milestone. We can go back a couple of years, right? Apple reached this milestone, and there's other companies that have crossed that 1 trillion market cap. And Bitcoin reached there very, very fast. So I bring this up because Bitcoin has a lot of similar features to gold and to other monetary properties. And oftentimes I have conversations with people, and they think that Bitcoin has taken off. It's 46,000, 47,000. It's too expensive. It cannot go anywhere but down, right? Well, if it truly has similar properties to gold, and it can replace or even grab some of that capital from gold, gold is roughly about 10 trillion. That means that Bitcoin has some market share to grab, right? Even if it takes 20%, 30%, 40%, it can double, triple, or grow up. And I think that's where you see a lot of very wild predictions of Bitcoin going to 200,000, 500,000, even a million, right? That's behind the idea of grabbing some of the similar attributes of gold. So the fixed supply is really important, right? That's the opportunity. Mm-hmm. Now, the core technology behind it is the blockchain technology, which I know that we'll probably get into it a little bit more. But in essence, Bitcoin solved a double spending problem. And what that really means is that in a digital world, you want to make sure that you don't spend twice whatever you have. Probably people in our audience, or even some of us, have purchased a ticket to a sports game, or a concert, and then we go to the gate, we try to scan it, come to find out it's a fake ticket. That's obviously brings up a lot of issues and money, right? You can't have that problem. So blockchain really provides a combination of technology features to make sure that there is no duplicate ownership in Bitcoin, and whoever owns Bitcoin, that is truly the case. So let me pause there. I know I covered a lot of ground here with Bitcoin and the history behind it.
No, it's really helpful and it really puts things into perspective. I had no idea it was capped. And actually, I didn't even know that you could buy part of a coin. That's was, obviously I'm not a huge investor, but I didn't know that you could buy just a piece of that. So there's so many interesting facets of this. And Kyle, let's bring you in here and talk more about that the blockchain technology, because you can't really have crypto without it, right?
That's exactly right. You can't. So Bitcoin, the history is interesting, but Bitcoin was actually not the first cryptocurrency. It's maybe the 15th or 20th that we're even aware of. It was just the first cryptocurrency to actually use blockchain technology to solve what Andres aptly named the double spending problem, right? Mm-hmm. No one can spend more Bitcoin than they have. No one can spend the same Bitcoin twice. But just to also back up there, I think that a lot of people synonymously link Bitcoin to blockchain and think that they emerged at the same time. But the fact of the matter is, blockchain is actually not a new technology. It's an amalgamation of very old technologies, some cryptographic, others automated. But the first blockchain as we know it really came to market in 1991. It was invented by a guy named Stuart Haber. And the first use of the first ever blockchain was actually to keep an immutable record of the answers to the New York Times crossword puzzle week over week, right? So it's a wildly non-commercial use case for it, but this technology gained notoriety because of Bitcoin and has since grown to be used in fields from cybersecurity to supply chain management to international trade and file storage. The list goes on and on and on. But I think it would be helpful for now just to explain a little bit about what blockchain is and why you can't have crypto without it, because that is true. So just from a high level, a blockchain, and it's not, just to take an aside here, it's not like the internet where we have one internet for now, see what happens with that. But there are multiple blockchains, right? Anyone can create a new blockchain. A blockchain itself is really just a protocol. It's a set of rules by which one internet user can transfer a unique piece of digital property to another internet user. And they can transfer that such that that transfer is guaranteed to be safe and secure, number one. Number two, everyone in the network can see that this transfer has taken place, but only the new owner of this digital property will be able to view the contents and use that digital property. And thirdly, no one can challenge the legitimacy of this transfer, right? No one can overwrite the record of what has occurred. It's very important. And finally, no one can replicate a piece of digital property without permission. So when I say digital property, that could be something like information, like medical records or a bank statement. It could be value, like rights to securities, a title to a car, or it could just be a line of code, which is ultimately all Bitcoin really is. So if that's getting a little abstract, which this topic can get very abstract very quickly, just to put it simply, blockchain creates a time-stamped, unchangeable record of who owns what at any given point in time. And this record isn't owned by a single entity, but instead it's shared and communally updated by a network of nodes, computers, individuals. We sometimes call them miners. They're the ones processing transactions on the blockchain. It's called a blockchain because when we add transactions to this ledger, to this database, they're added in sets, they're added in blocks. So you're not just adding one at a time, you're adding several at a time. Gotcha. And each block of transactions is actually cryptographically linked to the previous block of transactions. So if you were to try to change something 5 blocks ago, it would have a ripple effect causing red flags throughout the system. So it creates a chain of blocks, why we call it a blockchain. And it also helps with making sure that you cannot change the record of past transactions. So it's a fairly, okay, you have a public system, a public ledger. It's shared, communally updated, deters against changes to that record. A fairly simple concept, but for the first time ever, we have digital scarcity. And we have a decentralized network by which we can actually create digital assets or digitize physical assets. So it's birthing this incredible new economy far beyond the likes of Bitcoin and into other areas, including security tokens, non-fungible tokens, collectibles, et cetera. The list goes on and on. But blockchain really is at the core of all of this, whether it's crypto or other tokenized securities.
So are there other blockchain applications outside of cryptocurrency? I mean, just, how do you know which ones to use?
So yes, there are plenty outside of digital assets. So I use the phrase digital assets rather than cryptocurrencies. I'll get into why that is the case a bit later. But if you're using blockchain as an interface to communicate, it can provide a kind of trust between two parties that may not know each other or may not trust each other. A good example is, let's say, Kellie, you were selling your old car. I was in the business of buying a car, but you and I don't know each other, for example. So traditionally, you'd say, okay, you give me the $20,000 or whatever it is, and I'll give you the title of the car, and we'll be on our merry way. But I say, whoa, I don't know you. You give me the title of the car first, then I'll give you the $20,000. Classic dilemma right there. We don't trust each other. We can't have a transaction. You can design blockchain protocols such that maybe I send you a digital currency, could be Bitcoin, could be Ethereum, could be US dollar coin, doesn't really matter for the purposes of this example. But I send it to you contingent on receiving a digital copy of the title to this used car. I send you the 20,000, US dollars on the blockchain, for example. Now you know that I'm good for that money. And let's say I create a set of rules such that I can't get that money back for 30 days, right? But if you send me the title of that car electronically, there's another rule that says, as soon as you send that to me, you get this $20,000. So all of a sudden, I'm good for the money. I can't take it back as soon as I get the title. You get it as soon as you give me the title. If you don't give me the title, I can get it back. So now we have this third party, this layer of trust by which we can have a transaction. So it's kind of a simple example, but you can extrapolate that into different settings by which two parties need to interact but may not trust each other, which happens millions of times a day in the fields of cybersecurity, supply chain management, international trade is a huge one, file storage is a huge one. So there's a layer of trust that this provides such that we don't need a third-party institution that could capture value from our transaction, like take 10% of that $20,000, for example. So there's immense use cases well beyond cryptocurrencies for this underlying technology.
Yeah, it seems a lot safer too. Really interesting stuff. Andres, let's talk a little bit more about Bitcoin as an alternative asset. So this really for, the investor who's watching, it's really different than, your traditional stock, bond, funds, ETFs portfolio. What are those key differences and why should investors really care about this at this point?
Yeah, Kellie, and that's an important differentiator because it is completely different. And a lot of people get caught up in it being a stock. Bitcoin is not a stock, right? As I mentioned earlier, there is no company associated to Bitcoin. There is no shares, no company CEO, none of that. It also trades differently than your typical stocks, your bonds. It is globally traded 24/7 around the world with no central party behind it, right? Whereas the stock market only trades for a certain number of hours during the business days. Same thing with fixed income. And so it is traded very, very differently. And that's why it's seen as an alternative type of asset because it provides different risk characteristics and return characteristics. I mentioned it's very similar to gold. So it's an inflation hedge if it provides some sort of functional value besides what those money properties are. And the more the network of Bitcoin grows, the more useful it becomes, right? It's almost like the network of information that Google was able to capture, right? Google was able to capitalize on this, and now other search engines are trying to catch up, but it is very difficult for them because of the network effects that Google has captured. And I think it is something similar with Bitcoin. So very, very different than your stock and bond portfolios. You mentioned even ETFs or funds, right? Those are diversified baskets of securities, whereas Bitcoin is just that digital currency. So it is not diversified in that sense. And it is a reason why it is very important to pay attention on what you're investing. It is taxed differently. There's a lot of regulation or no regulation trying to get there. And then it is a very, very young industry, right? I mentioned 12 years old. There's a lot of innovation happening in this space. And these are just some of the reasons why it trades and it functions very differently than traditional stocks and bonds.
So since it's not trading then, do you help your clients with Bitcoin, or do people just have to get it on their own? Like how does that fold in?
That's a really good question. And I think it comes down to how much direct exposure somebody wants to this digital asset. So there's different ways to get exposure through companies that are getting associated with Bitcoin or even digital currencies. So we have big companies going public that are just an exchange, right? You have Coinbase, you have Robinhood that came out public this year. They're in the business of facilitating transactions, right? And crypto is one of them. Now, those companies get revenue from that, and in a way, you're making money by being an owner of those stocks, but you're not directly owning Bitcoin. So if you want to own the asset, there are other ways in the private space or even through your own due diligence that we can definitely help out. And it just depends, as always, with your risk appetite, right? Because this is a very young, very volatile asset. It depends on your goals, how long you're planning on holding this asset. So it really comes down to the investor and the specifics of the investor and how much exposure they want.
Kyle, how does something like Ethereum compare here? We have, I have to say, we have some of that, and it is fun to kind of watch it on the apps kind of go up and down. But how does that play into this conversation with crypto?
So Ethereum is structurally different than something like Bitcoin. Bitcoin is more like a commodity, right? It is, I think gold is a natural comparison because it is really just scarcity and just supply and demand that's driving the price there. Well, supply and demand drives every price, but Ethereum's value proposition is slightly different. So Ethereum as a blockchain can be a platform on which you can build unique digital assets. I can talk a little bit more about this. Ether is the native currency of that platform. So when you're investing in something like Bitcoin, you're investing or hoping that increased adoption will drive the price up, increase use in portfolios to hedge against inflation, things like that. When you're investing in Ether, Ethereum, which have grown to become synonymous with one another, you are betting that more applications, more businesses, more digital assets will use and be issued on the Ethereum blockchain. And in order for me to send you maybe a security or something that represents ownership in a building that I created on the Ethereum blockchain, in order for me to send it to you, I have to pay a transaction fee, and I have to pay that transaction fee in Ethereum, the coin. So betting on Ethereum is essentially betting that ecosystem will grow and more people will need access to Ethereum to be able to transact on that blockchain platform. So that's the difference. But just to, again, back up, because this can get in the weeds a little bit too quickly sometimes, I keep using the phrase digital assets instead of cryptocurrency, and for good reason. And this will sort of demystify what I'm talking about when I discuss other assets on a blockchain. So we have cryptocurrencies. We also have non-fungible tokens. We have tokenized securities, and we have digital fiat currencies, and we have platforms for all of the above. The Ethereum blockchain is an example of a platform on which you can have cryptocurrencies, on which you can have non-fungible tokens, tokenized securities. Ether is the currency that people can invest in, right? That common currency of that platform. Cryptocurrencies are its own bucket, and I'll go through each of these individually somewhat quickly, hopefully. So cryptocurrencies, if we're to take a step back and take a look at the value proposition of money itself, there's really three value propositions. So it's a medium of exchange, you can buy things with it, it's a store of value, and it's a unit of account. You can measure things with it day to day. With the advent of cryptocurrencies specifically, so not all digital assets, but just the cryptocurrency bucket, what we're seeing is a splintering of that three-pronged value proposition into individual silos by which you have specific cryptocurrencies optimizing to be the best at just one of those pillars. So for example, something like Ripple is designed to be the best medium of exchange. It's extremely, extremely liquid. It's meant to be held for minutes, seconds even. It's really just used to transact, right? Transact internationally with immediate settlement at a very low cost without the need for an intermediary. Then you have things like US dollar coin, things like Tether that are linked, pegged to the US dollar. So it provides that stable unit of account. They're not as liquid as something like Ripple, but they're also not the best store of value. I mean, the reason we all invest in markets here is because we know that US dollars or US dollar coins are not the best store of value. It's going to get eroded by inflation eventually. Then comes along something like Bitcoin. Now, Bitcoin was originally designed to be the internet's first medium of exchange currency, as was written by synonymously by Satoshi Nakamoto, creator of Bitcoin, whoever he, she, they, them is. That's what it was designed for. But it's evolved into more of a store of value, and for pretty good reason. Just functionally, Bitcoin, the Bitcoin blockchain, because Bitcoin has its own blockchain, can process about 7 transactions per second on average. You compare that to something like Visa can process 65,000 transactions per second. So if you were to go to a store, pay for something in Bitcoin at layer 1, you may have to wait around 10 minutes, 30 minutes for that transaction to clear. It's not exactly convenient if you're trying to get your coffee and hit the road, right?
Yeah.
But you have other next generation currencies that are using different types of blockchains with different protocols that can process up to 100,000 or more transactions per second. But that slowed velocity is really what's making Bitcoin more of a store of value, something like gold. And just on the spectrum from inherent value to no inherent value, on one side, we have things like wheat and copper. They're, whether or not there's a marketplace, there are value for those things. You can make bread, you can wire your house with copper. Move further along the line, you have diamonds, you have gold, there's some industrial use cases. Go further along, you have something like a fiat currency. Go all the way to the nth degree, and you have something like Bitcoin, which is, at the end of the day, just a social contract. It has value because everyone decides it should have value. Now, there's some functional convenience to it because we can transact without the need for an intermediary. It's not subject to manipulation by a single central government, although it is true that about 95% of all Bitcoin is owned by 2% of addresses on the blockchain. So maybe not subject to manipulation by a central government, but possibly subject to manipulation by large Bitcoin owners. But it is a social contract at the end of the day. And you can transact internationally with reasonably immediate settlement, far more efficient than something like a bank transfer internationally, which could take days and up to 20% of your capital. That is the cryptocurrency bucket. Very quickly, I don't want to dominate this leg of the conversation, but there's also non-fungible tokens. So unique types of tokens you can create. Think of like collectibles, like baseball cards. They're non-fungible. Right? A Hank Aaron card is not the same as a signed Mickey Mantle card. We can't just trade them like we could trade $2 bills. So they're unique. These unique assets can take the form of photos. They can take the form of information. They can take the form of media like video, music, for example. You can place them on a blockchain and you can have that scarcity for the first time ever. Whereas previously you couldn't have that scarcity. I mean, I downloaded my fair share of songs onto burned CDs when I was a teenager, right? Yeah. So it's changing the market for a lot of content creators. And a version of that is tokenized securities. So you can also program securities on a blockchain. Anyone can, right? So you're seeing decentralization of security creation as well, not to mention the eventual digitization, meaning putting on the blockchain of fiat currencies themselves, right? Like the US dollar, like the yuan, like the euro. So again, it's kind of a long-winded answer here, and I apologize, but there's cryptocurrencies, there's non-fungible tokens, there's tokenized securities, there's digital fiat currencies, and then there are blockchain platforms on which all of them run. So there's even the ecosystem of digital assets expands so much further beyond something like Bitcoin or Ethereum that it really helps to understand that this technology is creating an entire universe within the financial and payment system, let alone all of its applications outside of finance completely.
Yeah, it's a great answer. And honestly, it's interesting and to think about the things that we can just simply buy with Bitcoin. I mean, obviously, we were shocked when Elon Musk said, oh, you can now, buy your Tesla with Bitcoin. And I was just on Salvation Army's website the other day. I was making a donation for fire relief, and there was a little tab that said pay with Bitcoin. Like I just was really, every time I see it, I'm shocked. I guess I shouldn't be, right? Because it's becoming more and more commonplace. But Andres, I think for the benefit of our viewers today is, how do we incorporate all of this into our investments, our portfolio? Should we think about this new asset? Should we be afraid of this? Like, where is this all going?
Yeah, I think it's important to take a step back because, as Kyle was saying, it's easy to fall into a rabbit hole. I think digital currencies, Bitcoin for that matter, is just a sub-segment of finance. And finance is just a part of somebody's portfolio, right? Whenever you're investing, it is one of those 11 sectors that a portfolio should or should not be exposed to, right? Technology, communication services, finance. But within finance, there is this subsegment of, famously coined as fintech, right? There's a lot of companies innovating in this space. There's a lot of companies that are more directly associated with digital currencies, right? As I mentioned, there are some that purely derive their revenues from transaction fees in the crypto space. There are others that lend money to people that have concentrations in these types of assets, where a traditional bank may not loan money to these investors, right? And so I think it is a subsegment of somebody's portfolio. That's how it is important to categorize it, not get caught up in having a huge concentration or thinking that everything is going to be solved by Bitcoin. I think it's just a small component of somebody's portfolio. And then the other thing I would say is that as far as volatility is concerned, because that is a very important thing to touch on, right? Bitcoin has fallen tremendously in a very short period of time. We saw it earlier in the year, but if we go back even a couple of years, from 2015 to 2017, Bitcoin had corrections, and I say corrections, but in the crypto space, corrections can go anywhere from 10 to 80%.
Right. Yeah.
And the average correction in that 2-year time frame was 30%. And in that 2-year time frame, it had about 10 corrections, whereas the equity markets don't experience that type of volatility. So it is important to have the right position, the right size in your portfolio so that you're not overexposed. But at the same time, 12 months ago, Bitcoin was trading around $10,000. And so you do not necessarily want to be left out if it truly appreciates and it has some functional utility, despite all of the volatility. And that's why it's important to evaluate your goals and your time horizon and your risk appetite so that you can build your portfolio accordingly.
Yeah, sounds like it's just a good way really to diversify what you have, but not maybe put all your eggs in this one basket, for lack of a better term. So are there certain pros and cons of Bitcoin, especially as we're looking at this in the context of building out our portfolios?
Yeah, I think, so let's cover some of the cons first. I think legislation is still very trying to figure out what all this means, right? The taxing of Bitcoin and other digital assets is still being developed. In fact, part of the infrastructure bill that is being discussed wanted to regulate some different parts of the ecosystem, whether it was the miners, right, that are validating, as I said, transactions in this blockchain. and what kind of duties they had to go by so that regulation wouldn't come after them, or even designers of wallets, hardware wallets. So the government is really trying to figure out what this space means. Not only our government, but globally. I mean, we saw China kick out a lot of the miners from their country. There are other countries that are against it, but then there are some that are quickly adopting it, right? I'm sure that you saw the headline of El Salvador accepting it as legal tender for their country, which I think is a fascinating experiment. And it's yet to be seen what this will come about. But then as far as some of the pros is really that return potential, that inflation hedge towards towards other parts of your portfolio, and then just having that help your portfolio be more diversified.
Wow, it's just crazy to see where this is going, and I think I know for me personally, it's like, okay, we know as we make it our investments, there's going to be risk, right? Regardless of whether it's something in the stock market or regardless if it's crypto, but just interesting to see as more people and countries start to adopt this, your mind starts to think, wow, I should be getting into this game. What are the best ways, by the way, to kind of express a positive exposure to blockchain?
Some of the ways, I think that question really comes down to how much direct exposure you want. So I mentioned even companies like you mentioned Tesla, right? Tesla was going to start accepting, then Elon Musk renegated on those comments, and Tesla no longer accepts Bitcoin. However, they did buy Bitcoin and they put it into their balance sheet. And so Tesla, in a way, is indirectly exposed to whatever Bitcoin does. Square is another one, Visa is another one. There's a lot of companies that are trying to figure out. And so it really depends on how much direct exposure you want, because these companies obviously have other business lines where they derive their revenues. And then there are others that are more directly linked to Bitcoin. And then if you even wanted to go a little bit further, you can go into the private space and directly own the asset as opposed to a company that is associated to the crypto.
Sanjay, let's just kind of summarize here. I mean, what does this mean for everybody watching? If you're a business owner, you're an investor, like what are your thoughts on this as we kind of come to a close here?
So for us, Kellie, 3 years ago, we would not be doing a webinar on cryptos.
Right.
Back, a few years, if you ever had a discussion regarding Bitcoin or cryptos, the first thing that came to mind was these are rogue transactions. This is the underworld. This is the mafia. Rogue countries that don't trust their own governments, for example, and their own currencies, acting in this medium, right? That has changed now, right? So I think if I just step back a little bit and say, why are cryptos, and especially Bitcoin, on people's radar today, and why do we think it's a legit, digital asset going forward? Because we believe in it now, is just step back a little bit and look at all the negatives. So, if you ask me what keeps me awake at night, you talked about inflation early on when you made your opening comments. Inflation hit 5.4% in our country, which basically means that we are now losing confidence in the US dollar somewhat, because we're hoping that inflation is transitory, right? You look at how much money the Federal Reserve and Congress have put on the table in the last 1 year. By my math, $11 trillion has been paid out to people, businesses, households, and in some cases, even the government itself. So, and they're talking about another 3.5 trillion on the table right now. There's a 1.2 trillion infrastructure package. So we're talking about almost $16 trillion. And our economy is only about $22 trillion. Think about that, right? We're already at $26 trillion in public debt. And for the last 36 years in a row, our yields have been coming down. Interest rates are at rock bottom. So I think this results in a lot of loss of confidence, for example, in the ability of the government, for example, to move forward. And how are we going to pay off this debt?
Right.
Who is going to pay off this debt? Is this going to result in a negative impact on our economy and on our markets going forward? So it's not about just those rogue countries anymore. It's about our country too now. And we are watching, for example, right now, the political turmoil across the world, right? And plus, the other thing that people have forgotten is that the United States of America is no longer half the world's economy. We are 4% of the world's population. We are only 16% of the world's economy. And China drives more than 50% of the growth in the world. So we have lost our ability to basically influence the rest of the world when it comes to many other macro or micro, factors. So all these things sometimes result in a loss of confidence in the government, loss of confidence in the dollar. If you're looking for a hedge against the financial markets, which we know traditionally as stocks, bonds, commodities, real estate, and maybe some alternative investments, what's the alternative to all that stuff? Gold is not, because gold has certainly not been a hedge against inflation. We can see that for the last 30 years in a row. Gold would need to go back to $2,400 per ounce to just break even to where it used to be in 1980. So I think Bitcoin is very promising. Fintech has exploded. You can see half the world's population that was not banked is now basically using fintech to be part of that economy and that ecosystem. So the future belongs to technology. The traditional banks have failed, in my opinion, to be able to serve the masses in the world. And so Bitcoin is going to be, that, I think, driver of promise in the future. And I think we are positioned ourselves to see how we can take advantage of that.
Great explanation. I want to get to some of our questions from our viewers. First, though, can I ask you all three something? What is up with Dogecoin? Okay, can you just clear what is going on? It started as a joke, and then it kind of blew up and it's fizzled out again. And we've loved following it and may be guilty of buying some of that. So what's up with Dogecoin? Kyle?
Yeah, Dogecoin, I mean, you kind of summarized it pretty well. I mean, Dogecoin started as a bit of a joke. It was created by a Redditor, almost to laugh in the face of how easy it was to create a cryptocurrency that people could buy into. And it became what we call a meme coin, but it just gained notoriety. It gained that steam. The demand increased. The demand really pumped the price up. It got the attention of Elon Musk. Of course, then you saw it come tumbling back down. So Dogecoin's economics, I saw a question come across in the chat. There's not all coins have a fixed supply. I believe Dogecoin could be inflationary infinitely, if I'm not mistaken. Not to say that new coins will be minted, but they can be minted. And it's just one of those circumstances where maybe buyers are a bit over their skis in some areas here. There are over 10,000 cryptocurrencies. You really need to look not just at the tokenomics, the economics of the token for each of these cryptocurrencies, but the underlying technology that's driving that forward. Doge, a bit of a phenomenon, we'll say.
Yeah, tokenomics. That's another thing that would not have been in my textbook in college. Things have certainly changed. All right, let's get to some of these questions. Here's one from Rich, and Rich asks, I've only sold a volume of crypto once, but my current strategy is to hold and grow. Please talk about day trading versus long-term hold strategies. Who wants to tackle that one?
I mean, I can take it a little bit. So it just depends on what you're interested in doing. I mean, we've seen successful day traders. We've seen not successful day traders. We've probably seen more successful holders considering the growth of the space. I think this market, day trading in general, in any asset class, is extremely difficult, extremely speculative, extremely risky. It's even, I would say, even more difficult in markets that are subject to manipulation, given the wealth concentrations of something like Bitcoin. Talk about volatility. I think it was yesterday, maybe the day before, there was an incredible flash crash in crypto. At one point, Ether was down over 23% on the day. So you can make a lot of money that way. You can lose a lot of money that way. But either way, you're gonna need to stomach a lot of risk to day trade it. So buy and hold if you're constructive on the space growing in general.
Isn't that what you guys always say, right? Is just hold on for dear life.
In general, just like Kyle said, I think financial markets, you have a lot of institutional players and retail players, right? For retail players, if this is your day job, go for it. But if it's not your day job, just think about it. Do you really think you're going to win against institutions on this one? So I think day trading comes with its own risks. We don't day trade in our world. Andres and I are portfolio managers, mostly buy and hold and long run, investments. So day trading comes with a lot of risk. There's a lot of volatility, and of course, keep in mind you have a day job somewhere else, right?
Mm-hmm.
And if I can just add, then there are also big tax implications for day traders as well, right? So you're going already against some long-term investor that is favorably treated with long-term capital gains versus somebody that is trading in and out on top of possibly making a mistake.
Have you noticed with apps like Robinhood, does that, I don't know, I look at it as a positive. Part of me thinks, well, I'm curious your thoughts on how that's affected your business and your clients. But the other part of me actually feels excited about it because I know, teenagers are using it. And, back in the day, I mean, maybe our parents told us about investing, but we really didn't get it until we were older. So I think it has opened up the conversation and just the knowledge about trading in general, investing in general. So I think it's positive in that sense, don't you think?
It is. It is very promising. It is very positive. In fact, given how many millennials have jumped into the financial markets, is extremely positive because just a few years ago, we used to complain about the millennials not being participants in financial markets. They were not basically buying first-time homes because they were still renting or living with the parents, right? So there's good and bad. In my opinion, the good thing is that this is allowing a broader participation of the population in the United States in financial markets. And just to give you a quick background, the top 10% wealthy in this country own 70% of the wealth. The bottom 50% of the population accounts for 2% of the wealth only. So pretty much the bottom 50%, even though they may be educated from the Harvard, Stanfords of the world, they're not in the market. And you cannot build wealth unless you're in the market somewhere. So this has been the major reason behind the wealth divide. We look at socioeconomic issues, but we miss the point that half of the population in the United States is financially illiterate. So it's a great thing that now we have more participants, more retail traders, more retail investors through the Robinhoods of the world that are now participating. The downside risk is that many of them, you would like to hope they know what they're doing. And if they're simply chasing the GameStops of the world or the AMCs of the world, that's not a great thing. I mean, AMC has gone up 1,000% this year. Hard to explain why, right?
Well, that's the next question. And something that Lonnie asked here in the chat room is, with all the cryptos that are out there, okay, so then how do you know which one's going to catch on and which one won't? I mean, I know it's, a gamble, but are there certain things investors should be looking for or just reading articles? Like, what are some tips to find the ones that you think would possibly catch on? What do you think, Kyle?
Yeah, I can jump in there. So I spent a good amount of time in venture capital actually trying to do just that, determining which projects had the most promise. I think ultimately you have to begin with, is this digital asset solving a prevailing and widespread problem, right? In the case of Bitcoin, it can be remittance payments, it can be transaction fees, it can be banking the unbanked, very widespread problems there. Something like Ethereum creates a platform by which you can have decentralized assets traded globally, right, through the same medium. Yeah. So they're solving real world problems. If you can't figure out what they're trying, what the coin is trying to solve, or you think that there's a better solution out there for it, it's probably not worth investing in. It's probably speculative, we'll say. If you think you found a coin or a company that plans to build a coin that can solve a problem that's widespread, you just need to be able to determine, are they able to solve it? Okay, so we've identified a market gap and a market solution. Can this coin actually deliver on that market solution, or is it just a promise? So first, the value proposition. Secondly, can you deliver on it? And that's where you have to look at the technology. It's very difficult to be able to determine whether or not the technology is sound. You really need a deep expertise, which is why a basket approach makes the most sense. Even something like Bitcoin, which is the most secure value storage mechanism we have in the history of the world. We don't know if it will be knocked off as king of the hill and replaced by some new cryptocurrency with a superior blockchain protocol, right? Maybe it can process transactions faster, maybe it's more secure, maybe it doesn't take up as much electricity, et cetera, right? We don't know. Shielding yourself from that volatility in a basket of names through companies like Tesla that own some Bitcoin, through other companies like NVIDIA that are providing the graphics processing units on which proof of work blockchains run, all the way to Oracle, which is providing blockchain as a service. There are ways to access this underlying technology. There are ways to access digital assets and cryptocurrencies once removed from owning them directly that can help shield you from that volatility, help shield you from those regulatory headwinds that Andres was mentioning earlier. So extremely difficult to sort of stock select. In this case, they are not stocks. I should be very clear.
Right.
Coin select, very difficult, very difficult.
Hey, we only have 2 minutes left, but I want to ask Sanjay and Andres really quick. This is a great question from AJ. Are there any resources that allow you to place Bitcoin and other cryptocurrencies directly into a tax advantage account, such as a Roth IRA?
I'll jump in on that. So there's different providers that are trying to innovate in this space, but I think that there's a lot of regulation that is yet to be determined on how all this is going to be treated. I know that Kyle is very familiar with that space as well, and he may have a little bit more information. But I think all this is still in its developing stage, and you can jump into it, but I wouldn't necessarily say that it is well established yet.
All right.
I think that's right. Oh, sorry.
No, go ahead.
I was just going to say, I think that's completely right. There are some nascent products out there that serve as wrappers for individual cryptocurrencies, which you can place in a traditional tax advantaged account. But again, very nascent space, and you just got to know what you're getting into with the structure. Sorry, back to you, Kellie.
That's okay. Final words, Sanjay?
There's a lot of excitement about this new asset class that I think is going to catch a lot more traction. An old dog like me, that can also learn new tricks. And I wasn't paying attention to this 3 years ago, 4 years ago, but certainly now I am. And I can tell you this is a very good alternative investment, in the investment space. It should be part of your portfolio someplace. And certainly we are happy to help, direct you as to how you can get there very efficiently if you come talk to us.
I really appreciate your advice. And it just goes to show, I think you guys made a great point. If this isn't your day job, it's great to have people like you on our side, right? Because we aren't seeing all of the ups and downs, the changes, the trends that are coming with this, and it is an ever evolving space. And so it is comforting to know that you guys do that. You guys do all the work. And help us with investing, and just really appreciate your expertise, because it's fun to think about. It's fun to kind of ride for a little bit, and it'll be fun to see where this ends up. So if you have more questions for our panelists today, please feel free to reach out. You can go to goldenstonewealth.com and contact those guys. Kyle, do you have a good way to contact you?
You can just reach out to Sanjay or Andres, and they can connect through me, and I'm always available.
Perfect. You can contact me that way too. We will be posting the recording of this webinar as well. So if you want to watch again, go back, maybe you missed something. There was a lot of information to digest today, but really great stuff. Andres, Sanjay, Kyle, thank you so much.
Thank you so much, Kellie.
All right. And thank you for being with us. From all of us here from Goldenstone Wealth, have a great day. Talk to you soon.